Today, more ups and downs for the CPI. Hello again, it's Martin North from Digital Finance Analytics. Welcome to the next post covering finance and property news with a distinctively Australian flavour. While the monthly consumer price index, the CPI indicator, rose 7.4% in the year to January 2023, according to the latest data from the ABS. The ABS said this month's annual increase of 7.4% is lower than the 8.4% rise for the year to December 2022. It is, however, the second highest annual increase since the start of the monthly CPI indicator series in September 2018, signifying ongoing high inflation. The most significant contributors to the annual increase in the January monthly CPI indicator were housing, up 9.8%, food and non-alcoholic beverages, up 8.2%, and recreation and culture, up 10.2%. And the ABS said the annual increase for the housing group in January, which is up 9.8%, was lower than the December, it was 10.1%. The key contributor to this change were new dwellings and rents. In monthly terms, both dwellings, up 0.5%, and rents, up 0.7%, saw prices rising. However, rents are growing more strongly than they were 12 months ago, while the increases in new dwelling prices are moderating compared to a year ago. Prices for food and non-alcoholic beverages rose 8.2% annually, which is lower than 9.5% increase in December. On a monthly basis, most food and non-alcoholic beverage prices rose. The main exception was fruit and vegetables, which fell in price, down 2.3%. And prices for the recreation and cultural group remained elevated in the year to January. This is primarily due to holiday travel and accommodation, rising 17.8% for the year to January. But it is down from 29.3% for the year in December. Airfares and holiday accommodation prices tend to be quite variable, and this month is no exception. On a monthly basis, holiday travel and accommodation prices fell 7.2% in January, following a rise of 29.3% in December. CPI inflation is often impacted by items with volatile price changes, such as fruit and vegetables, automotive fuels, and holiday travel. The ABS said it can be helpful to exclude items with volatile price change from the headline CPI figure to provide a view of underlying inflation. And in the case of the monthly CPI indicator, when excluding holiday travel, the annual movement was a rise of 6.7% in January compared to 7.4% in December. And separately, the Australian economy rose 0.5% in seasonally adjusted chain volume measures, according to the ABS. In nominal terms, GDP rose 2.1% and the terms of trade rose 0.6%, and household savings ratios decreased to 4.5% from 7.1%. The GDP rose 0.5% this quarter and 2.7% through the year, but that 0.5% was well below analyst expectations, who were figuring 0.8%. Although this is the fifth consecutive increase, growth slowed in each of the last two quarters. Net trade, increased exports, and fall in imports and consumption were the primary contributors to GDP growth in the December quarter. Nominal GDP rose 2.1%, and the GDP implicit price deflator, the IPD, increased 1.6%, with higher domestic prices and a small rise in the terms of trade. The domestic final demand, IPD, rose 1.4% over the quarter and 6.6% through the year. This is the largest through-the-year increase since March quarter 1990, though elevated goods inflation began to moderate, particularly in pricing for construction materials as supply chains improved. Services inflation remains strong as skilled labour shortages and the tight labour market continue to add upward pressure to labour costs. The terms of trade rose 0.6% as growth in export prices were up 1.8%, and that outpaced import prices up 1.3%. Mining commodities drove the rise in export prices, consistent with global demand for Australian metals. The depreciation of the Australian dollar contributed to the rise in import prices. Net trade contributed 1.1 percentage points to GDP as exports increased 1.1% and imports fell 4.3%. And domestic final demand was unchanged. Growth was moderated in each of the last 4 quarters, in line with the wind down of the pandemic recovery and growing cost of living pressures for households. Private demand detracted 0.1 percentage point from GDP growth, driven by decreased private investment, down 1.7%, which was partially offset by a rise in household consumption, up 0.3%. Public demand offset private, contributing 0.1 percentage points GDP. The rise was driven by increased government expenditure, up 0.6%, but offset by a fall in public investment, down 0.7%. Changes in inventories recorded a build-up of $1.1 billion in December quarter, down from $3.9 billion in the September quarter, which detracted 0.5 percentage points from GDP growth, and private non-farm inventories experienced a rundown, with retail inventories declining, reflecting the fall in consumption goods imports. Exports of goods and services rose 1.1%, driven by services exports, while goods fell. Services exports rose 9.8%, reflecting the sustained recovery in education and personal travel as international students and tourists continue to return to Australia. And imports of goods and services fell 4.3%, and imports of goods, down 3.8%, drove the fall, and it was broad-based across consumption and capital and intermediate goods, aligned with weaker domestic demand. Imports of services fell 6.5%, and that contributed to a fall as Australian travellers favoured cheaper, short-haul destinations. This follows recent strength since the reopening of international borders. Household spending rose 0.3%, the weakest quarterly rise since the Delta variant lockdowns in September 2021. Growth in discretionary spending, up 0.4%, slowed to be more in line with essential spending, up 0.3%. Discretionary spending was led by hotels, cafes and restaurants, up 1.6%, and transport services, up 5.7%, reflecting residual post-lockdown demand. Spending in those categories slowed following 4 consecutive quarters of strong demand. Other discretionary spending on recreation and culture were down 1.4%, clothing and footwear was down 2.7%, and furnishings and household equipment was down 1.2%, as the cost of living pressures began to weigh on household budgets. Spending on food was up 2.4%, and that rebounded following 4 consecutive falls as pricing fell with increased availability of fruit and vegetables following supply issues earlier in the year. But private investment fell 1.7%, business investment fell 1.4%, driven by non-dwelling construction with the completion of major projects. And ownership transfer costs drove the fall in housing investment, down 2.1%, reflecting lower levels of property market activity following recent interest rate rises. Despite falling for 5 consecutive quarters, ownership transfer cost remains above pre-pandemic levels. Dwelling investment also declined as renovation activities supported by home builder reached completion, and that was offset partially by new and used dwellings at 1.4% as material supply improved for the 2nd consecutive quarter. And compensation of employees, the COE, rose 2.1% as tight labour market conditions continued in the December quarter. Sustained wages and employment growth translated to a 10.4% through the year rise in COE. That's the largest since September 2007. Skilled labour shortages continue to add pressures to wages, resulting in businesses paying more to attract and retain staff. And the Fair Work Commission's 21-22 decision to increase the minimum wages also contributed to strength in COE as award wage rises came into effect for the aviation, tourism and hospitality industries this quarter. Gross operating surplus rose 2.9%, driven by private non-financial corporations, up 3.7%, as mining profits rebounded, and financial corporations operating surpluses, up 0.5%, slowed as loan and deposit balance growth softened and banks' margins fell with increased competition in the deposit market. Dwellings owned by persons operating surpluses, up 2.1%, grew at its highest rate since September quarter 2011 due to rising rental prices, and mining contributed 1.1 percentage points to total growth in gross operating surplus plus gross mixed income, in line with increased exports of iron ore and coal, combined with higher pricing for some mining commodities. Electricity, gas, water and waste services was the largest non-mining industry contributing to growth, driven by electricity companies which experienced lower input costs in power generation and higher revenue through new contract pricing. And the household savings ratio declined from 7.1% to 4.5%. That's the lowest level since September 2017. Savings fell following a rise in household consumption and a fall in gross disposable income. Household gross disposable income rose 1.6%, driven by labour income up 2.1%, and non-labour income also grew as interest received on deposits rose 25.3%. Household income payable rose 8.9%. That's the largest rise since June 2002. And income tax rose, aligned with continued growth in wages, employment and hours worked, plus higher returns on investment income. Interest payable on dwellings rose 23%, reflecting further interest rate rises over the quarter. And the gross value added rose modestly by 0.3% as results were mixed across industries. Mining drove the rise up 3.2%, particularly iron ore mining, as newer mines increased productive capacity. But that was partially offset by coal mining as mines in New South Wales suffered from flooding. Combination of food services were up 1.4% and transport, postal and warehousing up 0.6%, and that rose aligned with continued household spending on hotels, cafes and restaurants and domestic air services, and growth in both industries was moderated over the last 2 quarters as pent-up post-lockdown demand for those services subsided. Electricity, gas, water and waste services were down 4.9%, and that experienced a large fall in reduced electricity consumption from a mild start to the summer on the east coast. But if you stand back and think about it, essentially, if it wasn't for the travel boom and the tourist boom and the student boom, things would be a lot worse than they are. But the takeaway is also that the overall GDP is looking pretty wobbly, the household savings ratio is weakening, and consumption is easing back, which then takes us back to that CPI number, which was a little weaker, but nevertheless still very strong. And it will be very interesting to see whether, in fact, CPI does weaken further and whether GDP goes higher or lower. And so, once again, we see the series of statistical data points gives us unclear direction as to where we're going to head from here. I suspect down, but we'll see. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.